what exactly is credit risk management? How do we define credit risk management as a process? CRM is the process of identifying the sources of credit risk, identifying the causes, quantifying the potential impact of the risk, designing mitigation plan to hedge against the risk, and monitoring the risk to ensure that the organization's risk-return profile is optimized for wealth creation. Let's break down this definition and understand it in more detail. Fundamentally, you have to identify the sources of credit risk. The sources of credit risk can be categorized into internal or specific to the firm and industry, or external to the firm or industry, which is basically economic risk, etc. The causes of credit risk also have to be very well identified. For example, the potential for fraud in a firm, or the potential of an earthquake if the business is situated in a region which is earthquake prone. The next step is to monitor the risk. It is not enough to identify the sources and causes of risk, but you must monitor. For example, if the bank is situated in a particular geography or a particular city where there is a social unrest, it is possible that the banks might be looted, in which case the risk has increased and the bank will have to take adequate step, either increase the security or maybe close the branch for some period of time. You have to design a mitigation plan to manage the risk, because it is possible that the risk will materialize at some point in time, howsoever low the probability. So how do you mitigate against that? One is to make sure the risk event doesn't happen. The other is to manage the risk once the risk has happened. For example, the risk of IT systems being down, in which case typically there is a business continuity plan and a disaster recovery plan which has to kick in. You should be able to quantify the impact if a risk event happens. For example, the impact of, let's say, a burglary. Will you be able to quickly stress what is the impact, how much cash has been lost as an example, and take steps to, let's say, lodge a FIR and maybe claim the insurance. Ultimately, you have to be able to optimize the risk return profile. Obviously, when you take higher risk, then only typically you get higher rewards. There's a risk reward relationship dictates that. But how high a risk to take? What is the optimum level of risk and return that you are willing to settle for? The definition of credit risk addresses all these areas. I hope you have understood how credit risk can be defined and the components of that definition. If you like this video, please do share as well as subscribe to my channel. Thank you very much. Cheers.